Cool. So next we're going to go to the investor panel. So I'd like to introduce the next panelists. So I'm going to call up Dino Vendetti, Managing Director, Seven Peaks Ventures. Will Price, General Partner, Next Frontier Capital. Bill Pescatello, Partner of Lightbank Ventures. David Hall, Partner, Rise of the Rest Fund. And Patrick McKenna, Partner at High Ridge Global, who's going to be moderating. Thanks, gentlemen.
All right, we'll snuggle up here on the couch. This is terrific. Boy, I have to say, following that's tough. But at the same time, I think all of us were sitting there going, how do we get a company, invest in a company at 5 or 10 million pre that is going to take a $100 million investment from SoftBank? So I think we start there. But also, I think as I was sitting in the audience in the first part of the morning, listening to those entrepreneurs from around the country tell their stories, and that was just getting me excited. And I know I had to peel a couple of you guys away from those entrepreneurs, so stick around because these guys definitely want to talk to you for sure. So we have a limited amount of time and a big topic. We're going to be talking about regional investing, early stage regional investing. And to kick us off, my name is Patrick McKenna, San Francisco-based investor, very focused on half my portfolio being outside of Silicon Valley, investments in Baltimore and Miami, Atlanta, Chicago. We have a very experienced group of early stage regional investors as well, or however you describe the investing you're doing. If we can just kick it off by just a quick intro of yourself and your fund, and maybe just answer is, what are you excited about in your investment thesis?
So great, thank you guys so much for having me. It's an honor to be here. It's great to be in one of America's next rising cities, Reno. My name is David Hall. I'm a partner at Revolution's Rise of the Rest Fund. We are a $150 million early and seed stage fund that invests 90% of our capital outside of Silicon Valley, New York, and Boston. Our belief and the ethos driving most of our firm investments is great entrepreneurs can start great companies anywhere. You'll never find in any of our agreements a requirement to uproot and move unless it's someplace across town that has cheaper rent. But we have deployed capital in over 36 cities across the US, and we're always looking for and excited about new entrepreneurs that are coming to this for the first time, that are looking and really tapping into their networks as far as like meeting the regional investors, meeting the ecosystem leaders, and being very positive momentum, part of the positive momentum of building their ecosystem within their city.
Bill Pescatello, partner at Lightbank, a VC fund based in Chicago, $180 million fund, early stage seed Series A. With the trend that's here, again, this real strong belief that great businesses can be built anywhere. We're really geographically agnostic. I'd say where we invest. A little over probably 50% of our portfolio is between the coast and Chicago. But again, we think great companies can be anywhere, and we're willing to get on planes, go anywhere it takes to kind of find those great companies and those great entrepreneurs. And in terms of what we're excited about, we've been building Lightbank for the last 7 years in Chicago. Through that, I think we've built a really great ecosystem in Chicago and around the country. And so we're seeing founders come around for the second, third time, and really seeing the value of that network and the founders and building up those relationships over time.
Yes, I'm Dino Vendetti with Seven Peaks Ventures. We're based in Bend, Oregon. I did the insane, crazy thing 6 years ago and moved from the Bay Area, where I'd been in venture capital for a long time, and decided to move to Bend, Oregon to start an early stage fund. Back then, most of my VC buddies thought I was nuts, but today, not so much. Like it's not as crazy as it seemed to be. So we've got a $30 million early stage fund, and we invest across the West, but primarily outside of the Bay Area. So there's enough capital there; they don't need ours. And what I think is really exciting is that there's in all these regional markets. They're all different, but in general, what I think you can find if you're methodical and really connected into the entrepreneur communities, you can find investment opportunities that are further along, actually, and de-risked from where they would normally be at the same valuation in the Bay Area. So you end up having companies that have got more progress around their business, they found product market fit, but the valuations are still rational. And if you can find those deals and you invest in those, then hopefully SoftBank will invest in a later round at some point. But I think the opportunity to actually deliver good returns as an investor is, for me, we're finding it easier to deliver good returns, investing in that strategy than just being yet another fund in one of 1,000 funds in the Bay Area.
Right.
Great to be here. My name is Will Price. I'm a founder of Next Frontier Capital. We're based in Bozeman, Montana, and have a new office in Missoula, Montana. It's great to be here. Yesterday, someone said that startup activity is not correlated with availability of capital. I just couldn't disagree more. I just couldn't believe he said that. What's the source for that? And I'll tell you that because in the absence of seed capital, entrepreneurs are forced to rely on SBIR and STTR grants. And we've seen a study that says if you take more than 5 SBIR or STTR grants, the odds of you shipping a product approach 0. Because you become a consultant to the government and you chase grant funding. The importance of seed capital in these early stage markets is to get companies to a minimum level of financial performance and metrics that then can attract capital from the coasts. Theory suggests that capital flows to return, and so why hasn't capital flowed to the heartland before? It's not because there hasn't been return there, it's because the assessment of risk for that capital is not possible in the absence of financial performance. And so unless you have seed capital available in these markets, these companies are stillborn. They either don't get started or they become dependent on the government as a source of funding, and that funding is not related to customers, products, shipping, or solving problems. It's related to kind of obscure research. And so I couldn't disagree more with the guy from Techstars yesterday. I don't think he's here today for me to debate him about it, but seed capital is fundamental to allowing entrepreneurs anywhere to create companies that then can attract national capital and ultimately perhaps SoftBanks.
So this is a great launching off point for us, because whether you're in the audience and you have a fund or you're thinking about raising a fund, or if you're an entrepreneur, I think it's really good to hear what's this side of the fundraising. So what's it like to raise a fund in a non-Big Three market? And so you recently raised a fund. Congratulations to Will. You just closed a new fund.
Yeah, I'll just go ahead and make the announcement here on stage. We just closed a $38 million fund last week. It's our second fund. And we had a great talk yesterday about it, but I'll just be very brief on it. The hardest thing about raising a regional venture fund is that institutions do not believe in regional venture capital. If you talk to endowments, pension fund managers, they think regional venture capital is a pejorative term. They're sick of hearing about the flyover states. They can't really point to success stories. And as asset allocators, they view venture as a challenging asset class, and certainly regional investing as a very challenging asset class. The other thing they have is they have minimum investment amounts. They tend to be in the $10 to $30 million range, and they have maximum percentages they can be in any one fund. The sum of those two mean unless you're raising a $200 million fund or plus, you're almost zeroed out of allocation. So the number one thing that we learned is that you have to find people that are high net worth. These are family offices or individuals that have a passion for entrepreneurship, but most importantly, they have an a priori belief in the ecosystem that you're trying to build because they're part of it. They live in it, they recreate in it, what have you. Trying to convince someone who's never been to Montana that Montana is a worthy place for venture capital allocation is an exercise in pain. Almost as bad as trying to talk to institutional investors. So what we did is we're very blessed. Montana is this bizarre dichotomy because it is home to incredible wealth that recreates there. The Yellowstone Club's a great example where Zuckerberg and Gates and the Google guys all hang out there. And yet there was literally $3 or $4 million per year being allocated to investments in Montana. And so what we were able to do is tap into people that knew the region well, that loved it, and wanted to take a small percentage of their net worth and allocate it to risk exposure for startups in our market. And so our first fund was $21 million, almost all individuals. And the second fund is we only have one institutional investor. It's the University of Montana, but the rest fall into that pattern I just discussed.
And so you guys have had you've raised bigger funds recently with 150, and then you had 200. Do you have a similar view of fundraising, or you've had a different view of it?
For us, historically, like a majority of our fund is actually from our founders. Okay. We also have a relationship with NEA over the years. They backed every one of our founders' companies before that. And so we had a very atypical kind of fundraise for our first one.
And well, Rise of the Rest did something a little different, moving from Revolution to Rise of the Rest Fund. Maybe you can give us a little background on that.
Yeah, so Revolution was started by Steve Case, and it basically started as a family office. And then as we raised our institutional funds, one of the things that we recognized as we were looking at and thinking about regional entrepreneurship was we needed a different model. We needed something because some of the same challenges that institutional investors would have had, but also we wanted to make it a bigger platform. And so we went out and solicited mostly sort of top of the fold individuals, and we were super fortunate to have them join us, guys like Bezos and Eric Schmidt, Meg Whitman, amazing families like the Koch family, the Walton family joined us. And so we were super privileged in our ability to have a great fundraise from amazing names, but more importantly, it just showed that they co-signed this notion that regional entrepreneurship is important, and being able to take some of the coastal ethos and infuse it into places that could start to to rise and rise rapidly. And by sort of having capital being one of those issues that can be more portable and move quicker than talent, we decided to raise the fund that way, and we're able to raise it in relatively short order.
That's terrific. Moving from the fundraising to kind of the startup community, and Bill's, I think you wanted to talk about, we were prepping, was like the community dynamic. And in Chicago, and you guys specifically have had a lot of success. You've had exits, and so you're getting that second, third generation. Can you talk about the importance of the startup dynamic? Yeah. And then like what advice for other communities that are kind of coming up the stage to get where Chicago is?
Sure. For me, kind of the experience having seen in Chicago, I think a lot of it's built off of what I saw from two of my founding partners, Eric Lukowski and Brad Keywell. Mm-hmm. Coming out of 2000, Chicago funding completely dried up. Like if you were starting a tech company in 2001, 2002, 2003, really tough go. There were regional funds that raised money. They blew a lot, and like they took money from all the families in Chicago, and people were very reticent to invest in tech after they'd lost tons of money, in the 99, 2000, and kind of the bubble burst. We were fortunate enough, Eric and Brad started the first company in 2001. They started 4 companies between 2001 and 2008. 3 of those that took public, a 4th one they sold for $700 million. The most notable companies, Groupon, which they started with Andrew Mason. And with that, when Groupon was really taking off, we started Lightbank, and we started investing through that. And the idea is, instead of just starting one company at a time, let's build up a bigger ecosystem. So now, we got basically a building where it's 1.8 million square feet. I think we make up 80% of that building between companies our founders have started and companies we've invested in.
So it's fully integrated.
Fully integrated, and right. So and you see the value. I mean, from early stage companies having founders around each other and be able to leverage, common learnings. We've made enough mistakes over the years that hopefully we're passing on some good information. And I think we've raised probably, over $1.5 billion just in 600 West Chicago, which is our headquarters, just for companies there. And so the ability to also connect those folks with coastal investors and be able to accelerate that growth, I think has been very meaningful. And I think we've created a really nice hub in Chicago, and there's other hubs that are there, but I think this is one in particular that's grown pretty fast. It's built public companies. I think we have 2 companies now. Groupon was started there, and then Uptake, which is Brad Keywell's latest company. I think it's the fastest company to a $2 billion valuation, which I think was basically did in 2.5 years. So there's some big things being created there, and then the talent that comes in, it's a virtuous cycle, where again, great founders, great talent creates good companies, and hopefully you're around there to feed that early stage capital and then connect them with the right folks to kind of grow it from there.
Yeah, that's terrific. And Dave, you've been on the bus. Right,
yeah.
Where you've gone to these very nascent in smaller towns. How would you contrast the story that Bill told about second, third generation entrepreneurism to what you're seeing across the different cities?
I would just remove a generation. With Rise of the Rest, we've been to 33 cities, 36 cities, 33 regions. A lot of them are represented in the room today. Omaha, Central Pennsylvania, Charlie is somewhere in here, Tennessee. And what we see is when we land or drive through these cities, we meet with the university heads, we meet with the politicians, we meet with the tentpole companies, we meet with the entrepreneurs that are working in corporations that have big outfits in some of these cities. And one of the biggest things we do, frankly, it's not secret, we convene them. We get them all in the same room, sometimes all in the same bus, and get them talking to each other, because a lot of the corporations don't see the fact that they don't see startups. It's just not in sort of their aperture. And so as a result, we're able to just bring these people together, often for the first time, meet each other, and then see some commonalities. I remember one of the best things hearing in one of our tours was one of the gentlemen who, huge company, couple $100 million in revenue, private company, and he's like, I realize now I'm not doing enough to support startups. And so then he's opening up his office as a place to host meetups, and he's opening up his balance sheet, and he's writing more checks now, all because, he was just engaged and activated as a supporter of the ecosystem in his town. So it's a huge benefit to just bring people together. And it works much more importantly in some of the smaller regions where there isn't that network density that that basically the Groupon exit helped create in Chicago, right? And I think you'll see it in other cities where you've got to kind of replicate whatever your secret sauce is of your city and leverage that network density to become more attractive to both coastal investors, but also, frankly, the men and women who are working in the corporations who are like, I have an idea, but I don't have I wish I knew that I had a place to go to leave my company job and start a company and become an entrepreneur. And that doesn't happen unless you create that space, that ecosystem for them to feel that comfort to branch out and start the company.
That's really good insight. And with Dino and Will, you both are unique in that you basically picked yourselves up and moved to these regions and become basically the first institutional early stage investors. How do you see the community dynamics? And this sounds probably pretty familiar, but you guys are on the ground every day working with local angels and local community to build these resources. Can you talk a little bit about what you guys have done specifically that maybe others can learn from?
Yeah, I mean, at least in Oregon, it started, probably 10 years ago, there really wasn't any venture capital. There were some angel investors. And I think in every market, you'll find that there's angel investors. They're local business people. They had some success. And they might not even be in the tech industry. In fact, most often they're not. They might have been real estate developers or whatever. And so there's a lot of local angel capital. But what needs to get activated is you got to bring them together. In Bend, what we did about a dozen years ago, a local entrepreneur had this idea of, hey, why don't we start this venture conference? And it was really an angel conference. And why don't we pass the hat around town? We'll set up a little LLC, and we'll pass the hat around town and raise $2,500 from each investor. And we ended up raising $100,000. And so then the conference basically was this process where all those investors participated in reviewing the different startups, and it winnowed down from maybe 40 to 20 to 10 to the final 5 that made it up on stage. And then that investor group then chose who to invest in, and they invested that $100,000 in that company. And that grew from that to now that annually there's probably $4 to $5 to $6 million that are invested out of that conference into the startups that are on stage. And it's but it was just this process of activating the local investors.
Educating them a bit too.
It's
what does a term sheet look like? What is a fair deal? You see some strange things out there when you get a real estate investor writing a term sheet for a software company.
Yeah. Well, and most importantly, disabusing them of the notion that failure is bad. Also. I mean, the one single thing that I hear most often in all of our regional markets is that, particularly from folks who've made their wealth in real estate or in other entrepreneurial avenues, that failure is not an option. And in the Valley, what Silicon Valley does better than any other place in the world is sort of accept failure and then value the risk of that failure better than anybody else. And just the ability to start replicating some of that and infusing it into the ethos of these these totally. Angels and early stage investors is invaluable.
And therein lies the other conundrum, which is, if you're investing in early stage startups, especially seed stage, there's a failure rate. So on the one hand, you don't want the local angel investor community to place big bets on one company. Right. Really, what the next layer of the ecosystem is when funds like Seven Peaks and Will's fund kind of show up. That's a way for those investors to invest in a fund that's got experienced managers where we'll build a portfolio of 20 companies. And so now you get diversification, and the And at least the way we set it up, I don't know, Will, if you guys do the same thing, but we created this ability for our investors to then make direct investments in certain companies as a sidecar.
So, Will, your experience was, you came in a little different because Right Now Technologies had a recent exit when you kind of showed up, and in Montana State is pretty sophisticated with technology and stuff like that. So your community story might be a little different.
You know, one of the great narratives when you read the tech press is they talk about the PayPal mafia. They talk, if you look back at Fairchild and Intel, the Intel Fairchild mafia. We're really fortunate to have Right Now and the Right Now Mafia. So Right Now was a software company in the customer support space started by Greg Gianforte, who's now our congressman. He sold that to Oracle for $1.8 billion. And so Bozeman had this great outcome where there was probably 800, 900 people there. And the alumni of that organization have done great things that we're just beneficiaries of. And so Christina Henderson's here. She runs the Montana High Tech Business Alliance. It was helped started by Greg. There's about 300 tech companies that are members of it. But if you look at Right Now, there's probably 25 companies that came out of Right Now. And they modeled a lot of great things. They were able to be a net importer of senior executive talent, convince people to move to Bozeman because it was a public company or had been backed by Greylock and Summit. And those people, once they got there, didn't want to leave. So when I think about what's happened in our market, that we're just essentially just riding that. We didn't have to do a lot of spark lighting, if you will. The fire was already going. And we're certainly nurture it, but there's many more people besides us that have made it possible for Montana to be a credible place to do business. And I think Right Now is really one of them. We also have a company called ILX Lightwave that was in our town, so there's a huge photonics cluster. Ken Fickler's here from the governor's office, and he's done a great job of working with private industry to help bring in companies. So ClassPass just opened up a big office there. So it's really a broad ecosystem level effort.
What's really interesting is that much smaller market than Chicago, but very similar spark. You had one company that had a success. Some people made some money, but then also some local entrepreneurs learned the way to do it, got motivated to be the founder on the next cycle.
Yeah.
Right?
I mean, I think of it. I mean, that's a trend you're going to see. It's the founders it's really the founders, not the money. And I know there's that argument before.
It's a talent thing.
But fortunately, the founders bring the money, and it's that cycle again that repeats itself.
And I talk about it now, like, well, we need one more of those companies because that was, 2012, I think, was the exit. But to get some people to move, one of the challenges is to get people to move is the trailing spouse issue. Like, what's your spouse going to do? Or if this company doesn't work out, there's not enough redundancy in the job market. Those are really real issues. And so if you have a breakout company where the risk is mitigated, people will come to your market and they can afford to pay people to move. They really hire national level talent. So I'd love to see another Right Now happen. Hopefully we'll be part of it where you have 200, 300, 400, 500 people imported into a community. Hopefully Michael gets to 500 employees and maybe that'll be it. But those kind of like unique breakout companies then make the conditions possible for others to follow.
And I think in general, and from Raz the Rest and other folks who are going around, you're going to find these underserved communities. And bizarre as it is, I see Chicago as severely underserved in terms of capital. There's more and more people are coming in, but it's the third largest city in the U.S. Like even being on a panel talking about
what's its percent of interest?
Like the heartland and being outside the major tech hubs. Like Chicago, again, like you look at the big exits that's there, whether it's Grubhub, Groupon, Braintree, CleverSafe. I mean, billion-dollar companies are being sold and bought. And I think it's one of the larger tech hubs that parallels the large population centers. And I think we're going to see more and more is every company is inevitably going to be a technology company.
And the capital gap kind of moves around a little bit. So, in the Northwest, the capital gap is really, it's not the small seed rounds, it's really the A round. Yeah. That $2 to $5 million A round, those are the rounds that are more difficult to get to raise for entrepreneurs, and some of the larger funds out of Seattle, for example, they grew to like $300, $400, $500 million size funds, so they've kind of naturally just moved to mid-stage investing, and they've created that gap that you got to fill somehow.
So this topic is very interesting, at least for those of us up here. And we even had an hour session yesterday, which we had about 25 people attend. It was very dynamic. So we already spent like an hour and a half or so on this topic. And I can go another hour and a half or 5, right? I'm wondering if there's some questions in the audience. We have a very limited amount of time, but I would love to. We got one here? Yeah. Oh, Dave.
I wonder if you can talk about what your LP base looks like specifically by industry and how you're involving either government or particularly real estate and
The question is, what does your LP base look like, and how are you involving government and industry? You can do that pretty quick.
Ours runs the gamut. I mean, we're all across the board with our LP base in terms of the industries that they originate from, e-commerce to finance.
Yeah, and as mentioned before, we're mostly self-funded, and then we have a couple other meaningful partners that we've had for a long time.
So our LP base is mostly high net worth individuals, family offices. The state of Oregon invested, Oregon Community Foundation, a couple of local smaller foundations, but I would say the vast majority of our investors are high net worth individuals.
No difference, yeah.
Was there another question? To finish up, I thought we'd just do a very quick, if there's an entrepreneur in the audience who is, sitting in their place outside of Silicon Valley or something like that, and they want to pitch one of you guys their business, and they're going to have, the 2-minute drill to give you, to just get you interested in taking a meeting with them, what would be the thing that you would advise them to lead with or present to you? Like, what's the crystallized thing they need to say?
So first, I would say don't be apologetic for being outside of the Valley or outside of New York City. Sell me on your strengths of why it's important to be from Reno, why it's important to be from Miami. And the other thing, don't send a doxin. It's my least favorite thing to get from entrepreneurs. Just the doxin, it's like a link that lets you just send a PDF format of a simple 10-page deck. Easiest way to get sort of through the chatter.
Yeah. For me, when I meet founders, I think one of the biggest questions I ask is, what have you done with what you've been given? So, how much capital you have done? If you've bootstrapped and built it up, what have you built from? What have you proven so far with the resources you had and the people that are super capital efficient, folks that do a lot with a little? Like those are the type of founders I'm always looking to back.
So good.
And for me, I like to. I want to really quickly figure out if this entrepreneur is really going after trying to build a big business, or if they're thinking small ball. Because if they're thinking small ball and they just want to build something up and get to 5 or 10 million in revenue and flip it, that's really not interesting. Because that doesn't deliver the kind of returns that we need. So I'm really trying to figure out if they're trying to build, if they're really mission driven and so passionate about wanting to change the world in what they're doing. Because I think you have to be that, especially if you're tucked away in a smaller regional market.
And Will, you bring us home?
Yeah, I'll just say, Roloff both at Sequoia talks about purity of motivation being the #1 predictor of success, and Ira talked about that yesterday about Tesla, like the mission-oriented, pure, the why. I think so many times about entrepreneurship, it's about getting through the challenges, and unless you're inspired by a why that's really meaningful, it's really hard to persevere. So I like to really understand the why.
Well, if everybody would join me in thanking this great panel. And only 2 minutes over, not bad.
Yeah, perfect.
Thanks, guys.
Yeah,
that was
it's really
fun.
terrific.
Yeah.
Yeah,
Yeah.
that was awesome.
Well.
Bill, thank
appreciate
you.
it, Bill.
You did a great job.
Thanks,
Yeah,
thanks.
thanks.
David.
Yeah, buddy.
David, thanks, man.
Can I shake everyone's hand too? Yes. Thanks, guys.